Sean Peche, Ranmore fund management founder and value focused fund manager that is probably sleeping a lot better than a host of asset managers around the world right now. Sean, wow, what a start to the year. I know we touched base a week ago, but so much has happened since. Let's start with what happened last night in the US. I'm talking all the major US indices. That's the S&P 500, Dow Jones, and specifically the Nasdaq. Sharp downturns followed by vicious reversals. What's happening out there at the moment?
Justin, yes, it was certainly a lot has changed in a week, and a sharp reversal, very sharp. You know, the Dow, I gather, got to one of the most oversold, a 7-day plunge, most oversold reading in 2 years, and so it's like a flock of starlings when one turns left, a whole lot of them do so. So really, yeah, big bounce, maybe a little bit of a follow through. Is this over now? Is the pain behind us and we're going to move forward? I don't think so. I think it's just the start, but that's my view.
Sure, and there's all this talk about inflation, interest rate hikes, etc. But is this just really a case of valuation starting to matter? I was getting concerned that my university and CFA notes were lying to me with regards to valuation the last few years.
Absolutely, Justin. I think that's exactly what the problem is. And I think we've had the wind blowing in one direction for a long time now. What's it, 13, 14 years? And so everybody is on the same side of the trade. I kind of said this last week, but now what's happened is you started to get the pain coming in, and they've done psychological studies that they found the investors try and resist pain. They dislike pain versus like pleasure 2 to 1. And you've got hedge funds are down double digits. The average Goldman Sachs, the average investor is down 11% of the Goldman Sachs. ARK is down 22, it's down 53 from the highs. Some of the most popular funds, and your clients, your listeners, go and have a look at the latest price data of some of their funds. You'll find that many of the most popular funds have given up half of last year's gains in 15 days. So we're now starting to get to the psychological part of the game, which is that psychology is important and pain is coming in, and some people are just, won't be able to take the pain. We can all self-medicate, but there's a reason you pay doctors, and that's for when things get tough and vitamins no longer just work. So I think that's what's going on. And I think an important point, and I haven't seen a lot written about it, but last Friday was options expiry. And there was rumored to be about $1.3 trillion of open interest expiring. And retail investors have made a lot of money from these options, because you'll take your mind back to AMC and those stocks a couple of years ago. It was easy. You buy some call options in Tesla. Tesla just keeps going up. You sell them, you make a lot of money. You put the money back on red at the casino table, buy more call options. All of a sudden, what happened? The options expired worthless. And so investors have lost a lot of money. And I think if you look at it, everybody's in tech, everyone's in passives. The passives in tech, the actives in tech, retail was in tech. And now all of a sudden tech's not working because of interest rates. And what I would say is we've seen interest rates pivot. We have seen growth and value pivot. I mean, you compare the value, we're up this year. You see that the pivot has been quite sharp. How many investors have pivoted their portfolios, or they're in the same portfolios last year? And so that's the problem. Everybody's still stuck in the old, listening to the old music, and the beat has moved on.
Sean, let's stay on the topic of behavioral finance or behavioral economics, but forget the institutions for a second. Let's talk the host of retail investors that came into the market post the COVID crash in 2020 and simply have unrealistically high return expectations. The market doesn't go up 20% every year, despite it doing so the last few years. The long-term average return on equities on the S&P 500 is around 7 to 8%. I stand to be corrected, but it's somewhere in that ballpark. From a behavioral economics perspective, do you think these new retail investors that have only experienced the good times are going to be able to handle this?
No, I don't. And I think you're absolutely right. I think behavioral finance is a great interest of mine. And if anybody wants to read a good book, James Montier is the guy. So I think what's also quite interesting is think of another pursuit in the world where you can play against the best in the business, the best in the world. All these retail investors are out there playing against Paul Tudor Jones. They're playing against, Stanley Druckenmiller and Jim Simons and all these hedge funds and the fund managers out there. You're playing against the best in the business. We can't go play tennis against Roger Federer, and if we did, we get beaten. So I think that's what's going on out there. It's been really easy, and people have thought, well, this is easy. I buy a few of the go-go tech stocks based on what I see on Twitter. Markets go up. I buy some passives, goes up. Who needs fund managers? And of course, the problem is it has been in the one direction, and it's fine to perform in line with the market when the market's rising. But who on earth wants to perform in line with the market when the market's falling? And so that's where I think it's going to be very interesting, because now what's going to happen is you're going to see the behavioral things. The market's going to bounce. Some other people are going to go, right, this is the bottom, we're in. They jump in, then it turns down again. They've got double the pain. It's going to be messy.
Let's talk inflation and the imminent interest rate hike cycle we're going to see. I follow Mohammed Al-Arian, president of Queen College and economic advisor to Allianz, very closely. He's been very critical of Fed Jerome Powell. He says that the Fed is playing catch up and the probability of a policy error at this point is very high. What does he mean by that?
I think he's right. I mean, I did a LinkedIn post, a while ago, in fact, and referred to it in one the other day, where I read the Fed minutes. I think it was June last year, and the Fed basically said we have no template. Everybody looks to the Fed and thinks they've got the answer, but we haven't seen inflation for nearly 40 years. And there are very few economists, career economists, who are still in the game, having been around that long. One of the few guys who's been around that long is Jeremy Grantham. And what did he say the other day? He said the markets are going to fall 50%. So when somebody like that, who's seen many bubbles burst and many Fed missteps, says something like that, I think people should sit up and listen. And the problem is, it would be far better if they'd stopped the rot, but inflation hasn't stopped rising yet. I mean, the oil price is up this year, and that's still got to feed through to numbers. And in fact, I was reading Procter and Gamble's comment the other day. It's only starting to now feed into utilities, because the utilities have had fixed gas prices and fixed coal prices, and those are now starting to roll. And so now you're starting to see inflation at the company level, and that's going to still get passed on to consumers. So we're not at the end of inflation. We may be halfway through, who knows? But that's probably the problem, is that because we don't know about this, because we haven't seen in 40 years, the likelihood of an error is high.
Sean, as a South African, I fall into this trap. I follow the JSE very closely, and then naturally the US indices. When the US sneezes, the rest of the world catches a cold. But you, as a UK-based fund manager, how has the London Stock Exchange held up so far this year?
Well, to be honest, I actually don't follow just the London Stock Exchange either. I follow Europe. I follow sort of more regional. I just don't. We overweight the UK. We massively overweight Europe. I mean, we only have 35% of our portfolio. In fact, less than 35% of our portfolio in the US. Benchmark is 70, and we have more in Europe than we have in the US. And benchmark in Europe is about 20. So Europe has actually been holding up relatively well. And so that's quite encouraging, actually. And if you look at the makeup of, and what's the biggest materials company in the US, I think it's Alcoa. There's not a lot. If you want to hedge inflation, well, what are you going to buy? You're going to buy a few oil companies and maybe one or two materials companies. Whereas over here we've got Glencore and Anglo American and Rio Tinto, and you've got Bayer, and you've got all these big materials companies in Europe. And so actually, if you want to hedge against inflation, maybe Europe's not a bad place to look.
Sean, we're 1 month into the calendar year, and Sean, Byron, Peche, top 10 market surprises are turning out to be less of a surprise than they were on the 8th of December, 2021. Are you expecting much of the same going forward that we've seen this first calendar month of the year?
Justin, you're ahead of me because I haven't actually looked at those in some time. I know that, I think I did say value would win, and we're moving in the right direction. Who knows? It's an early start, but at least we're moving in the right direction.